28th December 2016. Yes, almost 10 years ago, NSE, that is National Stock Exchange, filed its first DRHP. The exchange was ready to get listed, but a scandal broke out and NSE had to wait 10 long years to finally bring its IPO. What was that scandal all about? Why it took so much time? As an investor, should you really subscribe to NSE IPO? Watch this video till the end to find out everything related to NSE IPO. The NSE IPO is a pure offer for sale, that is OFS. What does that mean? It means NSE is not issuing a single new share. Instead, existing shareholders are selling part of their shareholdings. Who are these shareholders? LIC holds about 10.7%, Temasek Holdings of Singapore holds around 4.5%, SBI Capital Markets and Stock Holding Corporation hold about 4.3% and 4.4% respectively. State Bank of India holds around 3.2%. And here is a remarkable number. NSE has nearly 1,90,000 shareholders. It is the largest unlisted company in India by shareholder count. These shares have been trading in the unlisted market for years, changing hands through secondary transactions. NSE owns 90% of India's equity trading in effectively all derivative volumes. The listing is expected before December 26 and the numbers are actually staggering. A valuation of about 5 lakh crore and an issue size of up to 30,000 crore with 2 lakh existing shareholders waiting for their exit. The expected stake dilution is around 4 to 5%. Now, a pure OFS is something that you should think about carefully. When a company raises fresh capital through an IPO, the money goes into the business for expansion, technology, whatever. In an OFS, the money goes to the selling shareholders. It is an exit, not an infusion. That said, NSE does not need additional capital. It is sitting on plenty of cash and generating more over the quarters. Now let us look at the co-location scandal that kept NSE waiting for bringing its IPO. SEBI's investigation found that certain brokers had been given preferential access to NSE's trading systems through the co-location facility. Essentially, they were getting faster trade execution than everyone else. It was simply a governance failure. The IPO process was frozen. NSE submitted multiple NOC requests over the years in 2019, twice in 2020, and then again in August 2024. All were denied. The break came only in early 2026. NSE submitted revised settlement terms for 1,491 crore across the co-location and dark fiber cases. SEBI chairman confirmed in principle approval in January. The formal NOC arrived on 30th January 2026 and the NSE board finally approved the IPO plan on 6th February 2026. Now, what exactly are you buying if you subscribe to this IPO? NSE is not a growth story chasing market share. It is a monopoly with a regulatory moat. The exchange operates world's largest derivatives exchange by contract volumes. In equity cash, it is the third largest globally. Inside India, it commands roughly 90% of the equity cash market. In derivatives, that is futures and options, it is effectively the entire market. BSE has been gaining some share in options recently, but the base is very tiny. Now, what is the business model of NSE? It is quite simple. Every time a trade happens on the exchange, broker pays a transaction charge. NSE clears the trade and exchange takes a small percentage. Volume up, revenue out. That is the entire business. But the flip side is equally true. Volume down, that means revenue down, and that is what exactly happened in FY26. Let us look at the numbers. Full year FY26, which just ended in March, revenue fell 3%. Profit after tax declined 15%. The operating EBITDA margin compressed from 74% to 67%. Those headline numbers look concerning, but you need to understand why those numbers declined. SEBI introduced derivative curbs in October 2024. They were designed to reduce speculative retail participation in futures and options, and they worked. Equity futures average daily turnover fell about 14% year on year. Options ADT fell 8% and equity cash ADT fell around 7%. NSE also booked one-time provisions of around 1,400 crore. Now here is the number that changes the entire story. Look at Q4 FY26 alone. PAT was up 8% year on year and 19% quarter on quarter. Total income jumped 22% and transaction charges grew 34%. Premium value of equity options grew 43% quarter on quarter. Now let us move to the most important question for every investor. What is the price? The current unlisted market price for NSE shares is between 1950 and 2250. That implies a market capitalization of roughly 5 lakh crore. Compare that to BSE. BSE currently trades at roughly 60 times PE in the listed market. So NSE is pricing at roughly a similar multiple, perhaps a slight discount. That makes sense given NSE's structural dominance. Here is another way to think about it. NSE IPO is being priced to deliver a premium over the unlisted market price. That is unusual. Most IPOs price at a discount to the unlisted market share price. Here the opposite is happening. The message is very clear. There is enough pent-up demand that they can price it at a premium and it will still be subscribed. Let us understand the 3 reasons that this could be a strong long-term holding. First, monopoly with no real competition. BSE exists, but the gap is structural. NSE earns roughly 4 to 5 times BSE's revenue from operations. Building a third exchange at such a scale in India is functionally impossible. Second, the regulatory overhang has cleared. Third, index inclusion is automatic. A company listing at a 5 to 6 lakh crore valuation gets straight away into the Nifty 50. This will trigger forced buying from every index fund and ETF that tracks the index. Think about the SBI Nifty ETF, UTI Nifty fund, and every passive fund in the country. That creates a structural tailwind for the share price for initial 6 to 9 months. NSE's commodity derivatives market grew nearly 10x in FY26. Now there are 3 things that you should be really cautious about. First, revenue is hostage to SEBI policy. Now SEBI, as we all know, is already worried about retail investors losing their money in F&O. Already we have seen in October 2024 when SEBI came up with regulations, the NSE volumes dropped. As per a study, we all know that 93% of investors in F&O are still losing their money. More curbs from SEBI are likely possible, which will further decelerate NSE's growth. Second, the valuation is rich. A 58x PE on a business which has posted declining profits is a cause of worry. And the third, this is pure OFS, that is offer for sale, and no fresh capital. Existing shareholders, institutional and early investors are selling maybe at a peak. When insiders are selling, the retail investors should take a pause and at least ask themselves why. And do not expect listing day fireworks. Day 1 gains of about 5 to 10% will be reasonably good. This is not a typical SME IPO that lists at a 50% premium. And that is why NSE IPO is one of the most exciting and one of the most challenging investment decisions of 2026. So should you subscribe to NSE IPO? My advice will be read the risk disclosure section in the DRHP first. Focus on the Q4 FY26 numbers. Compare the final price band against the BSE's trading multiple. And if you do subscribe, apply with a 3-year horizon. First year will be driven by index inclusion, but beyond that, the stock will trade on volume growth and SEBI policy. What do you think? Will this make good money for the investors? Would love to hear your comments.